Life is full of milestones that shape our futures. Getting married, purchasing a home, and preparing for retirement are some of the most significant. Each of these events brings excitement, new beginnings, and big financial decisions. Without careful planning, what should be a time of joy and opportunity can turn into stress and financial strain. How can you ensure that you are financially prepared for these major life events? What steps should you take to balance your short-term needs with your long-term financial security? The key lies in proactive planning, setting clear financial goals, and making informed decisions at every stage of life. This guide explores essential financial strategies for marriage, homeownership, and retirement, helping you approach each milestone with confidence and financial stability. 1. Preparing financially for marriage. Marriage is not just about love and commitment. It is also a financial partnership. Many couples face financial disagreements simply because they do not align their money habits and goals early on. Here are some crucial steps to ensure financial harmony in your marriage. Have open and honest money conversations. Before getting married, it is essential to have a serious discussion about finances. Each person brings different financial habits, debt, and attitudes towards spending and saving into a marriage. Discussing these topics openly helps set realistic expectations and prevents future conflicts. Talk about income and savings, debt, including student loans, credit card balances, and car loans, credit scores and histories, financial goals for the short and long term, spending habits and budgeting preferences. Set shared financial goals. Once you understand each other's financial situations, establish financial goals together. These might include paying off debt, saving for a down payment on a home, setting up an emergency fund, investing for retirement, planning for travel, children, or future education expenses. Defining these goals helps create a roadmap for financial success as a couple. Create a budget that works for both of you. A combined budget allows couples to track expenses, manage shared responsibilities, and save for the future. When creating a budget, outline monthly fixed expenses like rent, utilities, and insurance. Allocate funds for savings and investments. Set aside money for personal spending and entertainment. Plan for irregular expenses such as vacations, gifts, and home maintenance. Regularly reviewing and adjusting the budget ensures that both partners stay financially aligned. Decide on joint or separate bank accounts. Some couples choose to combine finances completely, while others prefer to maintain separate accounts for personal expenses. A common middle ground is to have a joint account for shared expenses, such as mortgage payments and bills, while keeping separate accounts for personal spending. Choose the approach that best suits your financial comfort levels. Build an emergency fund. Life is unpredictable, and financial setbacks can happen at any time. Setting aside 3 to 6 months' worth of living expenses in an easily accessible emergency fund can provide financial security in times of need. This ensures that unexpected events, such as medical emergencies or job loss, do not derail your financial stability. Update legal and financial documents. After marriage, it is important to update key financial and legal documents, including beneficiary designations on retirement accounts and life insurance policies, wills and estate plans, power of attorney and healthcare directives. Ensuring that these documents reflect your new marital status can protect both spouses in the event of an emergency. 2. Financial strategies for buying a home. Buying a home is one of the largest financial commitments most people will make. Without careful planning, it can quickly become overwhelming. Here is how to approach homeownership responsibly. Determine affordability. Before shopping for a home, assess your financial readiness by considering household income and job stability, existing debts and obligations, credit scores, and mortgage qualification. Monthly housing budget, including mortgage, property taxes, insurance, and maintenance. Using an affordability calculator can help determine a realistic home price range. Save for a down payment. A higher down payment reduces the loan amount, monthly mortgage payments, and interest costs over time. Aim for at least 20% to avoid private mortgage insurance, P&I, and secure better loan terms. Understand mortgage options. There are different types of mortgage loans, including fixed-rate mortgages, which offer stable monthly payments over the life of the loan. Adjustable-rate mortgages, ARMs, which start with lower rates but can fluctuate. Government-backed loans, such as FHA and VA loans, which have lower down payment requirements. Choosing the right mortgage depends on your financial situation and long-term homeownership goals. Account for additional homeownership costs. Beyond mortgage payments, homeowners need to budget for property taxes, homeowners insurance, maintenance and repairs, utility bills, homeowners association, HOA, fees, if applicable. Planning for these costs helps prevent financial strain after moving in. Maintain a strong credit score. A higher credit score leads to lower interest rates and better mortgage terms. Pay bills on time, reduce credit card balances, and avoid taking on new debt before applying for a mortgage. 3. Planning for retirement. Retirement planning ensures financial security in later years. The earlier you start, the more time your money has to grow. Start saving as early as possible. Even small contributions to retirement accounts can accumulate significantly over time due to compound interest. The key is to start as early as possible, even if you can only contribute a modest amount each month. Maximize retirement contributions. Take full advantage of employer-sponsored retirement plans such as 400 and ONCUS. If your employer offers matching contributions, contribute at least enough to receive the full match, as this is essentially free money. In addition to employer plans, consider opening an IRA individual retirement account for additional tax-advantaged savings. Diversify investments. A well-balanced investment portfolio reduces risk and maximizes potential returns. Consider spreading investments across stocks for long-term growth, bonds for stability, real estate or other alternative assets. As retirement approaches, gradually shift toward more conservative investments to protect savings. Estimate future expenses. Determine how much you will need to cover living costs, healthcare, travel, and leisure activities in retirement. Consider potential inflation and healthcare expenses. Plan for Social Security and pension benefits. Understand when to claim Social Security benefits to maximize payouts. If you have a pension, research payout options and tax implications. Regularly review retirement plans. Life circumstances and financial markets change. Periodically review your savings strategy to ensure it aligns with retirement goals. Adjust contributions, investments, and spending plans as needed. Conclusion: what financial milestone are you preparing for? Major life events like marriage, homeownership, and retirement bring both excitement and financial responsibility. Planning ahead allows you to enjoy these milestones without unnecessary stress. Which financial milestone are you preparing for right now? Are you focused on buying your first home, merging finances with a partner, or building a retirement nest egg? Let's discuss in the comments. If you found this guide helpful, subscribe for more expert insights on financial planning, investing, and wealth-building strategies. The best time to plan for your financial future is today. So start now.